China's economy is facing its biggest crisis since Mao, and it could take the world down with it.
China, once the engine of global economic growth, is now losing its steam.
Authoritarian capitalism gave the CCP both prosperity and control for 40 years. However, this system that made China an economic superpower is now falling apart.
I think that there are real issues in China now. Real estate has gone down, stocks have gone down, salaries have gone down.
In this video, we'll explore how the tools that led to China's rise are now holding it back and what this means for the global balance of power. If you know any economic history, you know that China has grown a lot since Deng Xiaoping opened the country up to global trade. What you might not realize is that for the last 2 decades, it's been a lousy place to invest. If you invested in China's largest equity index 16 years ago, the CSI 300, you'd be up 80%. That doesn't sound too bad until you consider that Chinese GDP is up more than 500% during that same period of time. Let's compare that to 2 of China's neighbors. Singapore's GDP grew 360% from 19 billion in 1985 to 88 billion in 1995. During that period, the Straits Times Index returned 188% as it grew from 776 to 2,239. Japan's GDP grew 426% from 210 million to 1.1 billion during the 70s, while the Nikkei 225 grew 250% from 2,034 to 7,116. Both countries delivered far greater returns to investors in less time, despite having less GDP growth than China's recent run. This relative underperformance stems from China's investment-driven growth model, which prioritized massive infrastructure investments and industrial expansion over consumer-led growth. While this approach allowed China to build cities, transportation networks, and industrial complexes rapidly, it harbored a fatal flaw: unsustainability. As China poured more resources into fixed assets, the returns on these investments have gotten smaller and smaller. New airports stand empty, ghost cities remain uninhabited, and bridges connect sparsely populated areas. This inefficient allocation of resources created projects that failed to generate sufficient economic value. China's high-speed rail network, once a symbol of rapid development, now struggles with low ridership on many routes and is loaded with debt. And to maintain high GDP growth rates, the government has had to invest more, exacerbating the problem and increasing debt. This created an illusion of economic vitality that masks deep-seated structural problems. The looming crisis became increasingly apparent as China's debt-to-GDP ratio soared and productivity growth slowed. This means that the quality of growth is deteriorating. As companies struggle with overcapacity, local governments grapple with mounting debt, and banks face rising non-performing loans. As long as those GDP numbers remain high, the systemic issues can be ignored or downplayed. However, beneath the surface, the foundations of China's economic model are beginning to crack. It starts with China's real estate market, which faces a crisis of unprecedented scale. Home prices in some cities have soared to 25 times the median income, creating a bubble that threatens to destabilize the entire economy. The real estate sector, long a cornerstone of China's growth, accounts for a significant portion of GDP and serves as a primary vehicle for household wealth accumulation. Local governments have become overly reliant on land sales, which comprise 30 to 40% of their revenue, encouraging overbuilding and speculative investment. The emergence of ghost cities, large urban areas with vacant apartment buildings and infrastructure, exemplify the disconnect between official narratives and market realities. Empty developments like Ordos represent wasted resources and unrealized dreams for millions of Chinese citizens who viewed property ownership as a path to financial security. In this real estate bubble, creates a complex web of interconnected risks that threaten the Chinese financial system. Recognizing the gravity of the situation, the Chinese government has implemented measures to cool the overheated property market, including restrictions on lending and efforts to diversify local government revenue sources. However, the effectiveness of these interventions remains uncertain. It's probably just too late. And as public developers grapple with their over $500 billion worth of debt, they find that it trades for just pennies on the dollar in open markets. This bubble is bigger than the 2008 financial crisis was in the United States, and its implications for the world's manufacturing superpower will be enormous. China's banking system perfectly represents how much of its growth has been fueled by debt. The banking sector is 3.5 times the size of China's GDP. Local government financing vehicles add up to over $13 trillion in debt, and 80% of that is now in default. These financing vehicles, created to bypass borrowing restrictions, have become a critical vulnerability in the Chinese financial system. Across the entire banking sector, non-performing loan ratios are likely much higher than reported, because the government pressures banks to continue lending to struggling companies. This practice of extend and pretend may postpone a reckoning, but it will ultimately make the future even worse. As China's current account surplus has declined, the country has been forced to sell US treasuries to pay for its imports. This shift from net creditor to net debtor signals a fundamental shift in the Chinese economic position, and the consequences of China's debt crisis could be catastrophic for the global economy. China accounts for 18% of global GDP and 31% of global manufacturing. A debt crisis could disrupt international markets, supply chains, and potentially trigger a global recession. This would be the third balance sheet recession of the modern era. This phenomenon occurs when a debt-fueled asset bubble bursts, leaving companies and individuals focused on paying down debt rather than spending or investing. Japan's lost decade in the 1990s and the aftermath of the 2008 financial crisis in the United States exemplify such recessions. In China's case, the adjustment process could be even more painful and prolonged. The scale of debt, combined with the government's reluctance to allow market forces to operate freely, could lead to a protracted period of economic stagnation. Historical examples suggest that such adjustments can take over a decade with significant social and political consequences. As China attempts to shift investment from real estate to manufacturing, it risks exacerbating global imbalances. An increase in China's share of global manufacturing relative to its share of global GDP and consumption could lead to trade tensions and further economic instability. The interplay between authoritarian control and market forces creates a new set of challenges that will test the limits of China's economic model. And simultaneously, while all this is going on, Xi Jinping has consolidated more power than any leader in China since Mao Zedong. The Chinese governance model has shifted towards increased government intervention, as evidenced by regulatory crackdowns across sectors. Companies like Alibaba and Tencent, previously given latitude to innovate, are grappling with new restrictions that have sent ripples through China's business community. These measures have also had a chilling effect on foreign direct investment, which have fallen precipitously over the last few years. New legal frameworks, including the 2022 update to the Foreign Investment Law and the 2021 Counter Foreign Sanctions Law, have added layers of uncertainty. The 2023 update to counter-espionage laws, which effectively criminalizes due diligence activities, has further complicated the operating environment for international businesses. State-owned enterprises continue to play a dominant role in China's economy, serving as instruments for government-directed investment and economic activity. While providing stability, these entities often lag behind their private sector counterparts in efficiency and innovation. As a result, China's productivity growth has been slowing for the last 2 decades, even as its R&D spending has surged from 1.39% of GDP to 2.44% in 2021. As the country aims to transition from a middle income to a high income economy, productivity growth is essential for long-term economic expansion and rising living standards. Which brings us to the ultimate question. Can the CCP's authoritarian system effectively navigate the complex challenges that come with a globalized, integrated economy? This is perhaps the most important geopolitical question of the next decade. The United States and other major economies are now actively pursuing policies to reduce their dependency on Chinese manufacturing and technology, citing both economic and national security concerns. The trade imbalance with the United States has been a focal point of tension. Significant tariffs imposed during the Trump administration were largely maintained by the Biden administration, indicating a bipartisan consensus on addressing China's economic practices. And Trump seems prepared to ramp them up even further in his second term. The process of decoupling supply chains will be disruptive, but no one will feel the pain greater than China. In 2023, China's economic growth hit its slowest pace in decades. This deceleration highlights the convergence of challenges facing the country, including a property sector crisis, local government debt, demographic shifts, and geopolitical tensions. The government so far has held back on providing a major stimulus package, knowing that it can probably only shoot that bazooka one more time. The concept of gradual, then sudden, may prove relevant in China's situation. Problems can accumulate slowly until the system can no longer absorb additional shocks, leading to rapid unraveling. This is a runaway train. China's leaders can and will slow it down, but they cannot stop it from eventually crashing the Chinese economy. When it happens, its impact will be felt in every corner of the globe.